So the key learning objectives to understand the meaning of debentures and bonds, methods of issue of debentures, and the issue of debentures can be for cash or for consideration other than cash. The debentures can also be issued as collateral security. Then what are the sources for redemption of debentures and the treatment for redemption of debentures. Then the regulatory aspects for issue as well as redemption of debentures. We have Companies Act 2013 which stipulates all those regulatory aspects. Plus we have companies issue of shares and debentures rules 2014, share capital and debentures rules 2014. All those things basically talk about the compliances to be followed. The accounting aspects of debentures, including the issue as well as redemption. So all these things we are going to understand in this chapter. So starting with debentures. First of all, what is the meaning of debentures? As I said earlier, we talked about the sources of funds, and we said there are primarily two sources of funds, long-term funds. One is the owned capital, that is share capital, and second is the long-term borrowings. Now debentures is nothing but long-term borrowings. It helps in keeping the cost of capital under control. Now how does it help in keeping the cost of capital under control? To explain that to you, in shares we the shareholders obviously expect the dividend, correct? And in case of debentures, we are going to talk about it in detail later, but just to brief you as of now for this particular point, on debentures the companies pay interest, and that interest is at a fixed rate, 10%, 12%, whatever it is. So when the profits start going up of the company, obviously the shareholders will start expecting growing dividends, and hence dividend is nothing but ultimately it is an appropriation of profit for the company. It is a cash outflow, so ultimately it is a cost for the company. So the dividend is a cost of capital for shares, and as the profits grow up, the expectation of dividend also starts growing up, and that is why the cost of share capital starts increasing. But that is not the case in case of debentures, because in debentures you have fixed rate of interest regardless of the profit, and that is why when the profits are higher, the fixed outgo in the form of interest will remain same. That will remain same because it is a fixed rate, and that is what helps the companies in keeping the cost of capital under control. Now take an example of a company where it has issued the entire long-term funds in the form of share capital. So there the cost of capital will be the highest, whereas if the company has everything in the form of taken another extreme example, company has everything in the form of debentures, then the cost of capital will be the lowest. But obviously nobody would like to go for 100% debts, because that puts the company in danger from the point of view of long-term solvency. So that is what the companies have to balance between the cost of capital and the solvency position. But having said that, the debentures do help the companies in keeping the cost of capital under control. Debenture is nothing but an acknowledgement of debt by the company. When the company takes a loan, in return company has to give some kind of an acknowledgement to the lender that we have received the loan of such and such amount from you on such and such terms and conditions. So that document is nothing but the debenture. So it is an acknowledgement of debt by the company. These are long-term borrowings. These are never issued for short-term purpose. Interest is a charge against profit. No matter whether the company makes profit or loss, the interest has to be paid to the debenture holders, unlike the dividend. So hence dividend is an appropriation of profit. Interest on debentures is a charge against profit. Debenture holders do not carry any voting rights. In case of equity shareholders, obviously equity shareholders do carry the voting rights on all the matters to be resolved upon in the general meeting. Preferential holders do not carry the voting rights, but in exceptional cases they do carry the voting rights. But we have discussed that in the first chapter. Whereas debenture holders do not carry the voting rights, because debenture holders are not the owners, they are the lenders of the company. Now the debentures can be issued either at par or at premium or at discount, unlike shares which cannot be issued at discount now as per Companies Companies Act 2013, except sweat equity. But debentures can be issued at discount. Debentures can be issued for cash, and this cash can be taken either lump sum or in installments, or those can be issued for consideration other than cash. And the third way the debentures can be issued is the collateral security. So debentures can be issued as collateral security. Now what we mean by each of these things, that we'll study now in detail. So let us look at the journal entries for the issue of debentures. And the logic is similar to the journal entries for the issue of share, except the fact that in case of shares you used the account share capital. Here we will use the account debentures. So wherever the word shares was used, that will be replaced with the word debentures. But the logic more or less is the same. Now, first, as I said, basically the debentures also can be issued for cash in installments. So first the companies may take the money on application, then on allotment, then first call, second call, all that is allowed. But normally, in case of debentures, because it is a loan, entire amount will be taken upfront and not in installments usually. So the first entry for the receipt of application money, so bank account debit to debenture application account. Then the debenture application account will be transferred to debentures account upon the allotment of debenture certificates. Then debenture allotment amount will become due. So debenture allotment account debit. If these debentures are issued at discount, then discount on issue of debentures account debit, because it is ultimately a capital loss for the company, to debentures account, and to the extent of the face value. Just like share capital, here in debentures account also it will always carry the face value, and to securities premium account if the debentures are issued at premium. Now here in case of debentures also, the premium which is received on debentures will go to securities premium account, which will be governed by the uses that we discussed as per Companies Act 2013 in the first chapter, section 52. Discount on, I have shown it on the right hand side in the box. Discount on issue of debentures is a capital loss shown as negative number in reserves and surplus. This is set off, all these breakup of reserves and surplus will be given in notes to accounts. This is set off against either the capital profit, including securities premium account, or it is written off through profit and loss account over the period of life of the debentures in the ratio of outstanding amount of debentures, because the debentures can be redeemed in installments. So every year, if that is the case, every year the amount outstanding on debentures will go down, just like in home loan. How the home loan, as and when we keep repaying the home loan, the amount outstanding, principal outstanding, keeps going down. So similarly, in case of debentures also, if the redemption is happening in installments, the principal amount will keep going down. So in that ratio of outstanding amount every year, you can write off the discount on issue of debentures every year. Then the next stage, allotment money will be received. So bank account debit to debenture allotment account will get closed. Then the first call, second call will start. Debenture call account debit. So if it's first call debenture, first call account debit to debentures account, then the call money will be received. So bank account debit. If there are any calls in arrears, then debenture calls in arrears account will be debit to debenture call account. So debenture call account will be closed. And two, if the second call money has been paid in advance before the call is made by some of the debenture holders, then to debenture calls in advance account. So this is the same logic, for even the subsequent calls also. And you must have noticed it is exactly similar to the shares. Now, what happens is, one key difference between shares and debentures, or the preference shares and debentures, is that debentures, when those are redeemed, the redemption can happen at par, premium, or discount. And because this is a loan, if the redemption is going to happen at premium, obviously at that point of time it is going to be an extra cash outflow for the company. So it is a cost for the company. So that cost, which is the premium on redemption, has to be booked at the time of issue of debentures only, which is not the case in case of preference shares. But this is the thing that you need to remember always in case of debentures. So please remember, the premium payable on redemption of debentures has to be booked at the time of issue of debentures. And therefore, whenever the redemption is happening at premium, the accounting entries slightly differ. So we'll see all those permutations, combinations. Because the issue can happen at par, premium, or discount, and the redemption also can happen at par, premium, or discount. So there can be multiple permutations, combinations. So for each of those things, what is going to be the net entry at the time of issue? That is what we'll see now. So one possibility could be debentures are issued at par and redeemable also at par. So then the simple entry, since these are redeemable at par, there is nothing extra. There is no extra provision needed at the time of issue of debentures. So that is why the simple entry at the time of issue will be bank account debit to debentures account. Obviously, application, allotment, first call, second call, all those things will keep happening. But the net entry will be bank account debit to debentures account. Now, whenever you talk about debentures account, you always prefix that with some percentage. So 9% debentures account, 10% debentures account. It basically indicates the interest rate. Just like in case of preference shares, you say 10% preference share capital, 12% preference share capital, that denotes the rate of dividend. So similarly here also, you will prefix that with the percentage, which means the rate of interest. Second combination, the debentures are issued at par and these are redeemable at premium. So if these are redeemable at premium, then what you need to remember is that the premium payable on redemption has to be booked at the time of issue. So please remember, this premium is not paid at the time of issue. It will be paid at the time of redemption of debentures only. But the booking has to be done at the time of issue. The liability has to be created at the time of issue. So, right now for the time being, forget that these are redeemable at premium. Just concentrate on the issue at par. So then the simple entry will be bank account debit to debentures account. That is what I have shown in the first line, right? Debit bank account and credit debentures account. Now the extra thing that you need to book is because of the fact that these are redeemable at premium. And as I said, basically premium on redemption is ultimately a capital loss for the company. So you will say loss on issue of debentures account debit, and this is ultimately a liability for the company. So that is why you will credit premium on redemption of debentures account. So loss on issue of debentures account debit is a capital loss, and premium on redemption of debentures account is credit is a liability, which will be settled at the time of redemption. So this is your net combined entry: bank account debit, loss on issue of debentures account debit, to X% debentures account, to premium on redemption of debentures account. Another possibility, issued at premium, redeemable at par. Now if these are redeemable at par, that means no extra entry required at the time of issue. So just focus on issue at premium. So bank account debit to X% debentures account, and 2 securities premium account. Simple. Then issue at premium and redeemable at premium. So this is issue also is happening at premium and redemption also is going to happen at premium. So if the redemption is going to happen at premium, then that earlier entry that we spoke about, that same entry will continue here also. Loss on issue of debentures account debit and premium on redemption of debentures account will be credited. Because these debentures are issued at premium, then the entry for issue will be bank account debit to X% debentures account to securities premium account. So the combined entry, bank account debit, loss on issue of debentures account debit to X% debentures account to securities premium account and to premium on redemption of debentures account. Securities premium account is the premium on issue and premium on redemption of debentures account is the premium payable for payable at the time of redemption of debentures. Securities premium account is a capital profit which goes to the reserves and surplus, whereas premium on redemption of debentures is part of your liability, long-term liability, which goes to the long-term borrowings along with the debentures. Next combination, issued at discount and redeemable at par. Since redeemable at par, no extra provision needed. So just focus on issue at discount. So bank account debit, discount on issue of debentures account debit, and 2 X% debentures account. Another combination, issued at discount but redeemable at premium. So here basically companies taking losses on two fronts. First of all, the debentures are issued at discount. That itself is a capital loss. And secondly, the premium also, the repayment also is going to happen at extra price. So there also again it is going to be a capital loss. So capital loss is going to be at 2 times. So bank account debit for the amount which is received upon issue. Then the discount on issue of debentures and the loss on issue of debentures, which is that premium on redemption. Both those things you can club because ultimately both are capital losses. Both you can club under one heading called loss on issue of debentures. So please remember, in case of this scenario, the loss on issue of debentures account debit will consist of 2 things: discount on issue of debentures and premium on redemption of debentures. To X% debentures account, and that premium payable on redemption will be a liability and that will be credited to premium on redemption of debentures account. Now the second type of issue, that is debentures issued for consideration other than cash. We'll see that now. Logic exactly same as share. Now the debentures, when these are issued for consideration other than cash, these will be issued to the vendors for buying assets or taking over business from them. These are normally not issued to the promoters because promoters would like to become the owners of the company and not the lenders. So that is why in case of debentures issued for consideration other than cash, you have one category, that is debentures issued to the vendors. Now here also, if the purchase consideration is higher than the net assets value, so just to give you a simple example, that you decide to you have taken over net assets from a particular entity worth rupees 100 and the amount payable is say 120 as per the agreement. So then 20 is basically a capital loss because the company is going to pay extra 20 rupees to that particular entity for buying the net assets. So the difference between the purchase consideration and net assets value, which is 120 minus 100 in our example, is called goodwill. And if it is the other way around, so that is the net assets value taken over is 120 rupees and purchase consideration is 100. So it is like a capital profit. So then the difference between the two will go to capital reserve account on the credit side. The number of debentures to be issued in this case is, the formula is same as shares. The amount payable divided by the issue price, not the face value, divided by the issue price. So if amount payable is 11,000 rupees as an example, and the debentures are issued at a face value of rupees 10 plus 10% premium, so that is 1 rupee. So total issue price will be 11 rupees. So amount payable 11,000 divided by the issue price, that is 11. So 1,000 will be the number of debentures to be issued in this case. If the debentures are issued at discount, say at 10% discount, then 10% face value minus 1 rupee discount. So the issue price will be 9 rupees. So then 11,000 will be divided by 9 rupees and then you will calculate the number of debentures accordingly. So let us take the same, the related example for this. Assets worth rupees 20 lakhs were purchased from XYZ vendor and it was agreed to pay him 22 lakhs in return. So 22 lakhs becomes purchase consideration, and the net asset value is 20 lakhs. In the form of how the amount of 22 lakhs will be paid, in the form of 8% debentures of rupees 100 each at a premium of 10%. So in that case, the number of debentures to be issued will be, I have shown it below. Amount payable is 22 lakhs divided by the issue price, which is 100 plus 10 rupees premium, 110. So 22 lakhs divided by 110. So 20,000 debentures to be issued. So now coming to the entry, first the assets are purchased. So whatever assets are purchased, those respective assets will be debited to the extent of 20 lakhs. Correct? Because the book value of the assets is 20 lakhs. The purchase consideration is 22 lakhs. That means 2 lakhs extra the company is going to pay, which is a capital loss which will be debited in goodwill account. So goodwill account debit 2 lakhs, and the amount payable will be credited to that vendor's account, to XYZ's account, rupees 22 lakhs. That is the first entry. And now this XYZ's account will be settled. So XYZ's account debit 22 lakhs to 8% debentures account. Now 8% debentures account will always carry the face value. So the number of debentures is 20,000. Just now we calculated. So 20,000 into 100 rupees face value. So 20 lakhs. So to 8% debentures account, 20 lakhs. And to securities premium account, it will be 20,000 into 10%, that is 10 rupees per debenture premium. So 20,000 into 10. So 2 lakhs will be the securities premium account. So to securities premium account, 2 lakh rupees. So this is how you pass the entries in case of debentures issued for consideration other than cash. Another way you can issue the debentures is debentures issued as collateral security. Now what we mean by collateral security is basically an additional security given to the lender. Suppose I am a company and I am taking a loan of 100 rupees in the form of debentures, or in the form of long-term loans. Now that lender, that is the bank or financial institution, obviously will need some kind of a security. So I have given my machinery as a security, primary security to the lender. So what it means, if tomorrow if the company is unable to repay the loan, then that bank or the lender will be able to confiscate the machinery and sell it in the market and recover the loan amount. Now let us take another, in that same example, let us take another extreme case that, because of recession in the market, the value of machinery is actually now almost negligible. Bank is unable to recover any amount by selling the machinery because nobody is ready to buy the machine because of the recession. So in that case, even by selling the machinery, the amount of loan will not be recovered by the bank. So then what to do? Then as an additional security to them, the debentures are issued by the company. So if the bank is unable to recover the money by selling of the primary security, which is machinery in this example, then these debentures will be taken by them, and then they will officially become the debenture holders of the company. So, and once they become the debenture holders of the company, then as per the terms agreed in the debentures certificate, they will be able to recover the loan amount at a later stage. So in this case, these debentures are given just as an additional security. So this word additional basically means collateral. So collateral security means additional security given to the lenders. It is invoked when the primary security is insufficient to recover the loan amount. What will happen if the loan is repaid? Then obviously if the loan is repaid, then there is no need for exercising these debentures. So then these debentures will be released. So then these debentures will not come into effect. Interest in this case is paid only on the loan amount and not on these debentures, because these debentures are just a book entry on paper. For issuing the debentures, the company is not getting any additional money. The money is received at the time of taking a loan, and just as an additional security, the debentures are given for the time being. on which again the additional money is not received. So please remember, in this case the interest is paid only once by the company, that is on the loan taken from that financial institution or the bank. Again on debentures you don't pay, the company doesn't pay interest. The interest on debentures will be paid only when the debentures are exercised, the debentures are invoked by the lender. That means if the company is unable to repay the loan, the primary security value also is insufficient, then obviously that lender will invoke these debentures, and then they will become the debenture holders. So then in that case, from that point onwards, the interest on debentures will be paid, because then from that point onwards the debentures come into effect. But till that time there is no question of paying any interest on debentures. So how do we disclose this? How do we pass this particular transaction in the books of accounts? There are two ways you can do that. As I said, basically because these debentures issued as collateral security are just on paper, there is no money coming in or going out. So then one simple option is, don't pass any journal entry, just show it as a disclosure item in the notes to accounts. So in that case, whatever loan has been taken from the financial institution or bank, for that loan in the notes to accounts, just make a disclosure that this loan is secured by a collateral security of X% debentures of rupees so and so each. So disclosure made against the loan taken in the notes to accounts. That is one way to disclose it. Or another way is basically that since the debentures are issued as a collateral security, pass some entry so that it will get recorded in the books of accounts and it will get tracked. So in this case, because the debentures are issued as collateral security, then another logic says that pass the entry so that the transaction will get recorded in the books of accounts. So then one effect is obviously the debentures account will have to be credited. So to X% debentures account. Now the debit cannot be to bank account because company is not receiving any money by way of issue of debentures in this case. So that is why temporarily you will debit an account called debenture suspense account. Now so the entry is debenture suspense account debit to X% debentures account. Then how do you show it in the books of accounts? Debenture suspense account is deducted from the debentures account, and then obviously the net amount will be zero. So, but in the notes to accounts in the long-term borrowings, you will show debentures account less the debenture suspense account and show the net amount as zero. So that is how it has to be disclosed. On clearing the loan, so when the loan is repaid, then you don't need this entry. So then the above entry will be reverse. So it will be debentures account debit to debenture suspense account. So on clearing the loan and releasing the debentures, the above entry will be reverse. Suppose the loan is not repaid, then obviously the debentures will be invoked by the lender. So then what you will do, that loan account will have to be closed. So loan account will be debited, and then this debenture suspense account also will be closed. So it will be credited. So effectively loan account is closed, debenture suspense account is closed. What remains is basically these debentures account. So then in the long-term borrowings you will have these debentures account amount appearing. So this is how you pass the entries in case of debentures issued for consideration, debentures issued as a collateral security. Now we will come to the redemption part, redemption of debentures, and the meaning of redemption is same as the redemption of preference shares that we discussed in the first chapter. So debentures may be redeemable, that is repayable at par or premium or even at discount. Ultimately debenture is a loan, it has to be repaid to the debenture holders. So that can happen either at par, at face value, or at premium, that means at an extra price, or at a discount. So it can be even at a lower amount also. Technically, yes, even the redemption can happen at discount. Now you will wonder, how can the redemption of debentures can happen at a discount? Who will accept that? Sometimes what happens is basically the interest rate on the debentures is very high. So anyway, the lenders are getting high interest regularly. So in that case, they may be willing to accept the redemption amount at discount. So overall, they will still basically be benefited net. So in case debentures are to be redeemable at premium, a provision for the redemption for premium has to be made at the time of making the issue. We saw that earlier. Irredeemable debentures, that means the debentures which are not to be redeemed. These are perpetual in nature. They continue year after year and cannot be redeemed unless, in two cases, there is some contingency happening. So there is some contingency which is mentioned in the terms of the debentures, and only if that event happens, then only the debentures will be redeemed. So that is one way of irredeemable debentures. Or if there is no contingency, then the only contingency is basically the winding up of the company. So in that case, upon winding up of the company, these debentures will be redeemed. and they will have a priority over the repayment of preference share capital and equity share capital. Debentures once redeemed can be reissued, and once reissued will carry the same rights and priorities as per the original issue. The redemption period can be maximum 10 years, like in case of preference shares we saw, the redemption period can be maximum 20 years. So similarly, in case of debentures, the redemption period can be maximum 10 years. For infrastructure projects, if these debentures are issued for infrastructure projects, then the maximum term of redemption can be 30 years. So it is 10 and 30 years in case of debentures. There are various ways in which the redemption of debentures can happen. One, the entire amount is paid at the time of the maturity. So that is called lump sum payment. So lump sum payment paid at the time of the maturity, that is at the end of the life of the debentures. So whether 5 years, 6 years, 10 years, whatever it is, at that point of time only the entire amount will be paid, entire principal amount will be paid. Interest will be paid anyway on regular basis, either 6 monthly or 1 yearly, whatever is agreed in the debentures. So that is lump sum payment method. Another way to redeem the debentures is annual drawings. So you repay in equal installments. So by paying equal amount every year back to the debenture holders. Another way to redeem the debentures is convert these debentures into equity or preference shares, or issue new debentures in place of the old debentures. So for this is called convertible debentures. Now for issuing convertible debentures, you need a special resolution in the general meeting at the time of issue of convertible debentures. So in case of convertible, once the convertible debentures are issued, then it is an option given to the debenture holders. Instead of cash, they can convert those debentures into equity shares, preference shares, or new debentures, whatever is agreed upon in the conversion terms. So if the debentures are converted into new debentures, then the old debentures will be assumed to be redeemed, and in their place the new debentures will come into effect. Then another way to redeem the debentures is purchase of these debentures in the open market. So in this case, the company is purchasing its own debentures from the open market, which is basically it is like it is similar to the buyback, wherein the company is buying its own shares back. So similarly, in this case, the company is buying its own debentures from the open market. Now, once these debentures are bought back, there are two options that the company can have. One, either cancel those debentures immediately, or keep those debentures and cancel it at a later stage. So when these debentures are cancelled, it will amount to redemption of debentures. Till that time, it is not called as a redemption, it is just a purchase of own debentures by the company. So after purchase, the debentures may be immediately cancelled, or company may hold its own purchased debentures for some period of time with the intention to resell. If the company doesn't want to resell, then the company will cancel those debentures. When such debentures are purchased at a price lower than the face value of debentures, suppose the debenture face value was 100 rupees and the prevailing price in the open market is say 90. So at that point, at that price, the debentures are purchased by the company. So it is nothing but a profit for the company. So it will be credited to profit on redemption of debentures account at the time of purchase. And if it is other way around, the market price is higher than the face value, then it is a loss. So it will be debited to loss on redemption of debentures account. So when such debentures are purchased at the price lower than the face value, that means these debentures will be redeemed at a discount, because the market price is lower. Company is paying lesser money to the debenture holders. Company is paying lesser money to the debenture holders. That is what is called as redemption at discount. Now, when the debentures are to be redeemed, at that point of time, obviously, company needs funds. So, what are the ways in which these funds can be raised? So, following sources of funds can be used for the purpose of redemption of debentures. A. Accumulated profits and kept as general reserves, or take some investment instruments or insurance policy and redeem the same at the time of redemption of debentures. then raising the capital like issue of new shares or new securities and then raise the funds, or sell the fixed assets or investments and raise the funds. So these are the various sources of funds required for the purpose of redemption. Earlier we talked about the entries at the time of issue of debentures. Now let us see what the journal entries are to be passed at the time of redemption of debentures. So at the time of redemption of debentures, premium on debentures is premium on redemption of debentures is transferred to debenture holders account. You remember earlier we had created that liability if the redemption is going to happen at premium. So that liability now will be settled because now it is due for payment. So the entry will be debentures account will be closed again by debiting it. So debentures X% debentures account debit, premium on redemption of debentures account debit to debenture holders account. So debentures account and premium on redemption of debentures account will get closed and this will be transferred to debenture holders account. And then this is the entry for booking the amount to debenture holders account. Then when actually the amount is paid, that time the debenture holders account will be closed and to bank account. Now the Companies Act has laid down certain conditions for stipulations for protection of debenture holders. Now when somebody is giving a loan to the company in the form of debentures, there needs to be some kind of an assurance within the company in the form of its financial position that yes, company will be able to repay the amount back to the lenders. So for that purpose, there has to be some kind of a protection given to them. Obviously the primary security, collateral security, all those securities are there, but just to make sure that financially the company has sufficient reserves or sufficient funds available for repayment to the debenture holders. From that point of view, there is something which is required as per the Act. So that is what we will see now. So protection of debenture holders. Now debenture redemption reserve account is required to be created by the company by setting aside some amount of profit to this debenture redemption reserve account every year. So as and when the company every year keeps making profit, some portion of that will have to be transferred to a reserve account called debenture redemption reserve account. So this is, as it is an amount kept aside from the profit. It is an appropriation of profit, not a charge against profit. In certain cases, there is no need to create DRR. So no need to create DRR in case of sinking fund account method. So the company has invested the money somewhere else and company has created the sinking fund account. So then the sinking fund account itself acts as a reserve account, and that is why again there is no separate DRR account required. Or when the debentures are convertible debentures, to the extent of the convertible portion, there is no DRR required, because for convertible portion there is no cash outflow that is going to happen. The debentures will be converted into the shares or some new securities, and that is why there is no need for creation of DRR to the extent of the convertible portion. Or when the fresh issue of securities is happening for the purpose of redemption, or some fresh issue of securities is happening for the purpose of redemption, then that means the new funds are coming in the company, and hence in that case there is no need for DRR. So in all these cases the DRR is not required, but otherwise in any other case the DRR has to be created as an appropriation of profit. Now then obviously the next question is how much DRR has to be created. So that is what the next slide talks about. DRR is not required for financial institutions regulated by Reserve Bank of India and banks. For other non-banking financial institutions, at least 25% of the debenture amount has to be transferred to DRR for public issue of debentures. If these debentures are privately placed, then no DRR is required. So 25% of the debentures redemption amount, the debentures, whatever is the amount of debentures, 25% of that has to be transferred to DRR account. For other companies, it is 25% of the value of debentures issued. For all other companies, DRR required to the extent of at least 25% of the value of debentures. So everywhere else it is 25%. Only thing for financial institutions regulated by RBI and banks, DRR is not required. And if the debentures are privately placed by NBFCs, then the DRR is not required. But otherwise, in the other cases, 25% is the minimum amount required to be kept in DRR before the redemption of debentures happens. Every year, on top of that, there is some other condition also that is required to be followed. Every year by 30th April, the companies are required to maintain the DRR. The companies are required to maintain DRR. So by 30th April every year, companies which are required to maintain the DRR, they will deposit at least 15% of the value of debentures maturing during the year ending 31st March of next year. So not only that the DRR has to be created, it is not sufficient to just create DRR. 15% of the value of debentures maturing during the year ending 31st March next year, that amount has to be invested somewhere in certain specified instruments. And the said amount to be used only for the purpose of redemption of debentures, not for any other purpose. So to be used for the purpose of redemption of debentures maturing during the year. So 15% is the amount which is required to be invested, and DRR to be created is 25% of the value of debentures before the redemption happens. And then at no point of time, the amount remaining invested in these specified instruments will fall below 15% of the value of debentures maturing during the year ending 31st March. So at no point of it is not sufficient that 15% amount is invested, because if that's the only condition, then what will happen is 15% will be invested and after some time the amount will be withdrawn by way of selling those specified instruments. So that is not allowed. So the Act says basically at any point of time, the amount invested in these specified instruments cannot fall below 15% of the value of debentures maturing during the year ending 31st March of that year. All these rules for partly convertible debentures will be applicable only to the non-convertible portion of the debentures only. For convertible portion, as we said, the DRR is anyway not required, and this investment also is not required. After complete redemption, then there is no need for DRR. So then whatever is the balance in DRR will be transferred to general reserve account, because anyway the debentures, the redemption has happened completely. But this will happen only after the complete redemption of debentures, not partial redemption of debentures. Now when this DRR is created, this process is called redemption out of profits. So suppose 25% of the debenture amount is transferred to DRR, then to the extent of this 25 rupees, it will be called as redemption out of profits, else it will be called redemption out of capital. Now let us see when sinking fund method is followed. That is, the amount is invested somewhere, and in place of DRR, a separate sinking fund account is created, which is a liability. Then what are the typical entries that we will have to follow? You must have learned this already in case of the depreciation chapter earlier in your college days. So there is a sinking fund method for depreciation. The logic of that is similar to the sinking fund method that we are going to see here for redemption purpose. So, and just to repeat, when sinking fund method is followed, so there is a sinking fund account created. So in that case, you don't need to again create DRR, because the sinking fund account itself acts as a DRR. So the sinking fund is just like your liability that you are creating for the purpose of ultimately using it for the for the redemption purpose. So there are two accounts separately. The investment account, which is called sinking fund investment account, that is an asset, and the fund account that you are creating, which is basically a liability to be used for the purpose of repayment, that is called sinking fund account. It is not sinking fund investment, it is sinking fund account. So end of year 1, when the amount is invested or kept aside, so profit and loss appropriation account debit to sinking fund account. So some portion of the profit you are keeping aside in sinking fund account, and then the amount is actually invested in the specified securities outside the business. So it is sinking fund investment account debit to bank account. These are the two entries to be followed at the end of year 1. Then from second year onwards, at the end of each subsequent year, on the investment amount, you will have interest. So bank account debit to interest on sinking fund investment account, and this interest on sinking fund account will be ultimately transferred to sinking fund account. It is not a revenue profit, it will be added to the sinking fund account. By that extent, your sinking fund balance will increase. So interest on sinking fund investment account debit to sinking fund account. Again, in the subsequent years also, you have to keep aside some portion of profit and put it in sinking fund. So that first entry that we spoke about will continue. Profit and loss appropriation account debit to sinking fund account. Now the time for making investment. So sinking fund investment account debit to bank account, just like the second entry at the end of the first year. The only thing is here what you need to remember is this sinking fund investment account debit to bank account. In this entry, the amount to be invested will be equal to the fixed portion of money that you have decided to invest plus the interest that you have received in the current year, because this interest also will be reinvested in the specified securities. So these are the entries at the end of each subsequent year. Then at the end of last year, what will happen is now you don't have to invest the money. It is not time for making an investment. Instead of now, it is time for selling the investment, get the money and use it for the purpose of redemption of debentures. So in the last year, you will not make the investment. Instead you will actually sell off the investments. What are the entries to be passed at the end of the last year? Whatever amount you have invested so far, anyway in the last year also you will get the interest. So bank account debit to interest on sinking fund investment account, and this interest will be transferred to sinking fund account. So interest on sinking fund account debit to sinking fund account. Some portion of the profit will have to be kept aside even in the last year. So profit and loss appropriation account debit to sinking fund account. Now you will not make the investment. Instead you will sell it off. So the entry will be exactly opposite. So bank account debit to sinking fund investment account with the sale value, sale proceeds. Now you may make profit or you may make loss on sale of investment. So whatever is the profit or loss, ultimately it will be transferred from investment account to sinking fund account. So if it is a profit, then in bank account debit to sinking fund investment account, you have shown this entry at a higher amount. So this will basically keep a credit balance in sinking fund investment account, right? Because suppose you have invested 100 rupees. So on the debit side in investment account, you have 100. You have sold it for 120. So on the credit side, you have 120. So 20 rupees is the profit. Now, since you have sold the investments, the investment account will have to be closed. So what you will do, this 20 rupees you will debit in investment account, transfer it to sinking fund account. So for that, the entry will be sinking fund investment account debit to sinking fund account. If it is a loss on sale of investment, exactly the opposite entry. So sinking fund account debit to sinking fund investment account. Then finally, you don't need sinking fund because now the debentures are to be redeemed. So what you will do, sinking fund account debit to general reserve account. You will close sinking fund account by transferring the amount, transferring the balance in sinking fund account to general reserve account. So sinking fund account closed, sinking fund investment account closed. Now it is time to redeem the debentures. So debentures account X% debentures account debit to debenture holders account, and ultimately these debenture holders will be paid back. So debenture holders account debit to bank account. So these two bank account, this money which is required to be paid to the debenture holders, this will come from the sale of investments, that entry which you have already seen, that we are going to pass in the last year. Bank account debit to sinking fund investment account. So with the help of that money, the debenture holders will be paid back. So this is how it happens in case of the sinking fund method followed for the purpose of redemption. Now, instead of investing the amount in specified securities, sometimes the companies may go for insurance policy. So in that case, the logic is similar to sinking fund. There are certain differences. Now, how does the insurance policy work? Every year the company will pay the premium, and then whenever it is time for redeeming the debentures, that time the company needs money. So company will surrender the policy, insurance policy, get the money, get the surrender value, and use it for repaying back to the debenture holders. So the difference between sinking fund and insurance policy method, there are two primary differences. One, basically you don't get interest on the insurance policy. So there is no entry for interest. And second, usually the premium is paid at the beginning of the year, not at the end of the year. So these are the two key differences between the sinking fund method and insurance policy method. So at the beginning of each year, you are keeping aside some portion of the amount from P&L appropriation to debenture redemption fund account. This debenture redemption fund account is similar to your sinking fund account, and then the policy is taken. So debenture redemption policy account debit to bank account. This is basically the payment of premium. So these two entries will follow in each of the years except the last year, because now in this case there is no new entry required from the second year onwards for interest, because you don't get interest on the insurance policy. So that is why there is, these two entries will repeat till, except the last year. Now the last year, what will happen? Similar to sinking fund. Now there is no question of paying premium. What you will do is basically you will sell off the insurance policy and get the money and use it for the redemption purpose. So selling off the policy, bank account debit to debenture redemption policy account, then debenture redemption policy account debit to debenture redemption fund account for the profit or loss on sale of policy. Then you don't need debenture redemption fund account now, because now the debentures are to be redeemed. So debenture redemption fund account debit to general reserve account. So debenture redemption fund account is closed. Debenture redemption policy account is closed. Please remember, debenture redemption policy account is an asset account and debenture redemption fund account is a liability. And then finally, the debentures have to be the debentures account has to be closed. So debentures account debit to debenture holders account, and then debenture holders account debit to bank account. And this money is coming from the sale of insurance policy. Earlier we discussed that one of the ways of redemption of debentures is to purchase its own debentures by the company from the open market. So now let us see what happens when the debentures own debentures are purchased from the open market. So if the debentures are purchased and immediately cancelled, then and suppose this is happening at par, so that means 100 rupees was the face value and these are purchased also at 100 rupees. So then the debentures account will have to be closed and to bank account. Actually, it is a combination of two entries. First, when the debentures are purchased, you will say own debentures account debit to bank account, correct? And then against these own debentures, the original debentures will be cancelled. So you will have to close both the accounts. So original X% debentures account will be debit to own debentures account. So own debentures account also will get closed. The net effect of both is basically nothing but debentures account debit to bank account. Because you are purchasing and immediately cancelling, then even if you don't create separate own debentures account, directly set it off against the debentures account, that is also fine. Suppose if the debentures are purchased at premium, so then the debentures account debit to the extent of the face value, then you are the company is paying higher amount than the face value for purchasing the debentures. So that is why it is a capital loss. So loss on redemption of debentures account debit, which will be set off, since it is a capital loss, it will be set off against the capital profit including securities premium, or it will be written off through the profit and loss account and to bank account. This is basically when the purchase is happening at premium. Suppose the debentures are traded at discount in the open market, then the entry will be debentures account debit with the face value to bank account to the extent of the payment happening, and since the lesser amount is paid than the face value, the difference will be nothing but profit. So it will be to profit on redemption of debentures account, which is nothing but a capital profit, and hence it will be later on transferred to capital reserve account. So this is what happens when the debentures are purchased and immediately cancelled. But not always that the debentures will be immediately cancelled. Sometimes the debentures will be purchased and those will be kept with the company itself. And after a certain stage, those debentures will be cancelled. So then in that case, you will have to have a separate account called own debentures account. You cannot immediately close the debentures account, because the debentures are not immediately getting cancelled. So what happens when the debentures are purchased, held as investment for some time and then cancelled? So at the time of purchase, you will have own debentures account debit to bank account at whatever value you are purchasing. Same entry, own debentures account debit to bank account, whether it is at par, premium, discount, doesn't matter. So then when these debentures are cancelled at a later stage, that time what you will do, if these debentures were purchased at par, then debentures account debit, so debentures account will get closed, and to own debentures account, so own debentures account will get. Suppose these debentures were purchased at premium, so that means in the first entry, that is own debentures account debit to bank account, it was higher than face value. So then what is happening is, your own debentures account is having, say, suppose for example the face value is 100 rupees and these are purchased at 120. So own debentures account is having a debit balance of 120. Your original debentures account is having a credit balance of 100 rupees. So what you will do, debentures account you will debit by 100 rupees own debentures account you will credit by 120 rupees because both the accounts will have to be closed now because the debentures are cancelled. But then you will have a difference of 20 rupees, which is nothing but a loss on redemption because company is paying higher amount. That will be debited to loss on redemption of debentures account, which will be set off against the capital profit. Suppose the debentures are purchased at discount originally. So in the first entry, own debentures account debit to bank account, suppose it was 90 rupees. The face value is 100. So this is purchased at a discount. So debentures, when the debentures are cancelled, the debentures account will be debited by 100 rupees because that is the face value. Own debentures account will be credited by 90 rupees because own debentures account also will have to be closed. Now there will be extra 10 rupees difference, which is a profit because company is paying lesser amount to cancel the debentures. So that will be credited to profit on redemption of debentures account. And since it is a capital profit, it will be later on transferred to capital reserve. So then you will have one more entry, which is profit on redemption of debentures account debit to capital reserve account. Now, when the debentures are purchased, technically what happens is, till the time the debentures are cancelled, the debentures are still in existence. And now who is owning these debentures? The company itself is owning the debentures. Company is the debenture holder of its own debentures. That is what it means when the debentures are purchased, unless until those are cancelled. Now, obviously, if the company is owning its own debentures, there is interest portion on these debentures as well. Just like how the other outside debenture holders are entitled to have interest on the debentures. Similarly, if the company itself is owning the debentures, its own debentures, then for those debentures also the question of interest on debentures arises because these debentures are not yet cancelled. So then how do you give effect of that interest on the purchased debentures? That is what we will see now. So when the debentures are purchased and immediately cancelled, then there is obviously no question of paying interest on these debentures because the debentures are cancelled. However, if these are not yet cancelled, then the debentures still remain and therefore there is question of interest which is applicable on these purchased debentures. Now, how do we show this interest? There are two options to record. It is like saying that, on one side, company is supposed to pay interest on these own debentures. So it is going to be expense for the company because company is supposed to pay. But at the same time, who is going to get the interest? Company only, because company only is the owner. So on one side, it is cost for the company. On the other hand, it is gain for the company. So option 1 says don't show the entry. Don't pass the entry for the interest on purchase debentures. That is one option. Second option says that no, pass the entry so that it gets tracked in the books of accounts. So one, sub interest account debit. So whatever interest is payable to the outside debenture holders as well as to the company for its own debentures, put that entire interest amount in the interest account. Suppose it is 100 rupees. Out of 100 rupees, suppose 90 amount is payable to the outside debenture holders. Then the entry and 10 rupees is payable to the company itself for its own debentures. Then the entry will be interest account debit 100 rupees, to interest on purchase debentures account 10 rupees, and to debenture holders account 90 rupees. Obviously now the debenture holders will have to be paid this 90 rupees. So debenture holders account debit to bank account 90 rupees. This 10 rupees will never be paid because who will pay to whom? Company is supposed to pay 10 rupees to itself. So obviously there is neither cash inflow nor cash outflow. So for this 10 rupees there will be no receipt, no payment. Then this entire 100 rupees will be transferred to P&L because it is interest on debentures is expense for the company. So profit and loss account debit to interest account 100 rupees. Now what is happening is this interest on purchase debentures 10 rupees is still appearing on the credit side of the account, which will have to be closed. So what you will do, this 10 rupees you will transfer back to P&L. So interest on purchase debentures account debit to P&L account 10 rupees. So net what you are saying is the net expense for the company is not 100, it is 90 rupees. Because in the second last entry you debited P&L by 100. In the last entry you are crediting P&L by 10. So net effect in P&L account is 90 rupees. But the benefit of this option 2 is that you track this interest on purchase debentures separately in the books of accounts. So you can keep record of these transactions and take a look at it at any point of time in future also. In option 1, if you are not passing the entry, nowhere in the books of accounts you will be able to see the effect of the purchase debentures, the interest on purchase debentures. That is the benefit in option 2. Now, sometimes these debentures can be purchased as an investment. So, instead of making investment in some specified securities outside, company may decide to make an investment in its own debentures. So then in that case, there is a sinking fund account which is already created by the company. So then in that case, what you will do is one, slight difference as compared to the option 2 that we saw. And instead of, the difference is, instead of crediting that interest on own debentures to interest on purchase debentures account, it will be credited to sinking fund account. So interest account debit, taking the same numbers, 100 rupees, to sinking fund account, 10 rupees, which is nothing but interest on purchase debentures, and to debenture holders account. Then the rest of the entries will be the same. Profit and loss account debit to interest account, 100 rupees, and then debenture holders account debit to bank account, 90 rupees. And these 10 rupees will remain in sinking fund account. Later on, when the debentures are redeemed or cancelled, that time the sinking fund account will be transferred to general reserve account. Now, what happens is, when these debentures are purchased, or by the debenture, when the debentures are transferred from one person to another, in between the two dates. So suppose the debentures are the interest is payable on, say, 31st March each year, and the transfer of debentures happens, say, on say 1st January. Then technically what happens is, till 1st January, the interest is supposed to be received by the original debenture holder, and from 1st January to 31st March in that year, the interest is supposed to be received by the new debenture holder. So if debentures are purchased in between the two interest due dates, then the price of redemption can be either cum interest or ex interest. The price at which these debentures are sold or transferred, that price can either be inclusive of the interest portion for the earlier period, or it can be exclusive of the interest portion. If the price is if the price is inclusive of the interest portion till 1st January in our example, then this price is called cum interest. So please remember, cum interest means the price which is paid for transferring the debentures is inclusive of the interest portion for the prior period. Whereas if it is price is ex interest, that means the price does not include the interest portion, and the interest portion will be settled separately over and above the price. So if it is cum interest, then the price includes the interest from the last day of the interest. So suppose the debentures are transferred on 1st January 2015. So from 1st April 2014 till 31st December 2014, for that prior period, the interest is supposed to be payable to the original debenture holder. So this interest will be included in the price. So when the price is paid, it will be inclusive of the interest, and the original debenture holder will get the interest portion automatically by way of the price. So price includes the interest from the last day of interest till the date of payment. Now, why this cum interest, ex interest is coming in the picture? Because accordingly, the interest portion will have to be segregated separately by the company in the books of accounts when company is purchasing its own debentures, because interest is a revenue profit which has to go to P&L, whereas the price of purchasing the debentures doesn't go to P&L. That is why when the price is cum interest, the company will have to segregate interest portion and the remaining amount of debentures used for purchasing the debentures. If the price is ex interest, then price excludes the interest. Interest will be paid over and above the purchase price. So then the complication of separating interest from price doesn't arise, because anyway it is separate only. If nothing is mentioned in the question or in the document for purchasing the debentures, then the price is always assumed to be ex interest for securities other than shares. If in case of shares, if nothing is mentioned, then the price for the sale of shares is always assumed to be cum dividend. That means it is assumed to be including the dividend. But other than shares, in case of all other securities, when nothing is mentioned, the price is always assumed to be X interest, and hence it is understood that the interest will be paid over and above the price, that will be separate.